to make the market not stacked against you, you do have to think outside the box.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders Podcast.
G'day, Darren. Welcome to the podcast. How are you today?
It is, yeah. Good day.
Awesome. It's great to be on holiday, isn't it? Awesome. So we were talking about this idea before we started recording, and this is the idea that there's a lot of rumbling around, and I guess this happens a lot with forex traders in particular. At least that's my belief, that you hear a lot of forex traders talking about how the whole thing is stacked against them. My broker's screwing me over or whatever. And so, or you'll hear things like, oh, the institutions have all these quants and these algorithms, and they're in and out of the market so quickly, and they execute faster than you can, and all this stuff. And the idea is that the markets are stacked against the average Joe trader for one reason or the other. It could be the broker. It could be the fact that the big institutions get to push the price up and down, and they're the ones that move the euro and this and that. But my thoughts are, I've got lots of thoughts on this, but I'm curious to hear what your thoughts are on this idea of whether or not the markets are basically the odds are sort of tilted in the favor of others rather than your average trader.
Yeah, I'm not sure I would agree they're tilted in anyone's particular favour, but I do think that the markets are stacked against the average Joe trader, and not in a sort of conspiracy sort of way that we're being cheated or anything, but I just think that there's a lot of people trading, and there's a lot of money to be made. And so, we're playing a game that is highly, highly skilled. And essentially, if everybody is highly skilled, then, you really need to be highly skilled yourself. And then luck will also play a part in it. So, I think the idea that you can, just come up with a simple, systematic trading system and then make nice, consistent gains over the long period is a little bit unrealistic, because there is so much gain to be had out there, and so much skill and knowledge and education and the best minds, and that is what you're up against, and there's no getting away from that fact. And if you look at the performance of hedge funds that have got the best technology, the best information, the best minds, and many of them don't post returns way above the average, and and many of them have losing years. So the idea that you can just rock up, learn a little bit about price action, read one or two books, perhaps do a little bit of reading about psychology, and then you're going to make your living from trading is a little bit unrealistic. And so as harsh as it sounds, I think it is stacked against you, and you're going to have to work really hard. You're going to have to come up with some imaginative thinking. You're going to have to train your mind and learn about how you deal with emotions. You're going to have to keep good records. It's really competitive and hard, and for that reason, I would say definitely stacked against us. I know that's not really the angle you're going on, but that's how I perceive it.
Yeah, I think right when we enter into the markets, I think that the odds are stacked against us. I think the numbers sort of bear that out, but I think that it's kind of what you're saying, which is to me the reason why this is the case is not necessarily because your broker's gonna cheat you, not necessarily because these private funds have quants and algos and robots they're in and out of the market and manipulating it or whatever, but really I think it's because and hedge fund managers are just as prone to these as anyone else, as the individual trader who's trading in his underwear in his living room. We all have to deal with these psychological issues, and for lack of a better term, cognitive biases or errors in our thinking. All of these things come up, and so everyone in the market has to deal with these. So I think really the big competition for each individual trader, the big issue is yourself and your own issues that you have. And I think that's, to me, the tricky part. And I think that's, from what I've seen from traders, the very successful traders, the most successful traders, they understand this, and that this becomes their focus. In the end, it's no longer about the best exit, the best entry. It really comes down to, how do I get to a point where I can accept the decisions that I'm making, and how do I know if I'm making the right decision? So I'll give you an example. So if, like, let's say you're in a trade and you've sold the euro, and you decide that you're gonna take this euro trade until it makes you 120 pips, okay? But the euro trade goes 70 pips and starts to retrace sharply against you, and so you say, you know what, I'm gonna get stopped out at break even here, and I don't want to handle, I can't handle that, and so you dump it and you bag 60 pips. Well, the issue here is that your goal, and really what you wanted to do, was make 120 pips. You only made 50% of that. You made 60 pips instead. And the next thing you know, 4 hours later, it goes 200 pips in the expected direction, and you would have hit your 120 pip target. So the question is, what do you do with that information, right? Did you make the right decision when it was retracing sharply against you? You know, how do you deal with that? And even more importantly, what does that mean for the next trade? And how is that going to affect your thinking going into the next trade? And I think that's, to me, that is the meat of what we have to deal with as traders, is that right there, which is, you know what I mean? Like, that's it, right? That's really, to me, that's really what it all boils down to, is that.
Yeah. And I think, you know, I see a lot of traders where they use the discretionary element of their strategy to kind of paper over the cracks that there are some big holes in their strategy that they haven't thought out. So going back to the example that you gave, then I'm presuming that trader would have had a rule that, okay, my target's 120 pips, but if X amount, if price is giving me the signals that it's reversing, then I will manage my trade. And that is fine, because when you do your back testing, you would apply those rules and see if it is profitable over the long period. And the problem is a lot of traders don't have those rules. They have, okay, this is what works for me. I'm going to get in this trade on the euro, and my target is 120 pips, and there's no management in between. And then they manage it. So essentially, they end up trading a different system to the one that they've planned to trade. And I think that is the problem. And I see it more often on exits than entries, where traders get into a profitable trade, and then they alter their exit rules and they apply some sort of reasoning why they were allowed to do it this time. So I think, poor planning is a trader kind of stacking the odds against himself. And it's very hard to do that, because when you literally lay all your rules out bare with the minimum discretion, then you really get an honest appraisal of how well your system works or not, or how much of an edge you've got. I think a lot of traders are really uncomfortable with realistic edges. They want to believe that they're going to be able to draw a paycheck every month, just like they do with their work. And unfortunately, some people, some very special traders with really good edges might be able to achieve that. But there's I think the majority of traders, they don't have that, and they have, I know many good traders with long track records that have losing years. Okay, so and they specialize in one subject, maybe trend trading, so they clearly know their business, but they still can't avoid the fact that sometimes that's going to happen. So I think how we approach trading and how well we plan out what we're going to do stacks the odds against us. And I think sometimes we're a little bit lazy, and we just kind of live on the hope that my system is actually better than it really is.
Yeah. And I think what's interesting about the example we've been talking about is that you could do the exact same thing in that instance. you could have 120 pip, you're looking for 120 pips, you got out at 60 pips, and depending on what the rules are, so basically what you're saying is depending on what the rules are of your system, in one instance that would be the right thing to do and you execute the system perfectly, and in another you totally dropped the ball, right? Yeah, so I mean it all comes down to what you've planned out, how does your execution map onto your system. And I think that's it. I think that's really kind of the piece here that people are missing. Like, really when it comes down to, Darren, it's just responsibility. It's just taking responsibility, because it's a cop-out, isn't it? It's a cop-out when you say, my trading would have been better. I would have made money last month if my broker didn't keep slipping me. Or, I would have made money if that news hadn't come out the way that it did, that surprise unemployment number or whatever it was. It's like people don't want to admit that they're the ones that are pulling the levers in their account. They're the ones that are setting the lot sizes, putting the profit targets, getting out of the trades, getting in the trades. You're the one that's responsible for everything that happens to your account, and just taking that responsibility is a big step towards becoming a successful trader and a profitable trader. Because if you're always blaming the boogeyman and whatever that in whatever form, I don't really see how it's going to work for you. I just don't see how that's gonna work. It's just about accepting responsibility, becoming self-aware. And you can do that through. I know you're a big fan of writing things down, journaling, and keeping really good records. But in some way, it's about self-discovery. It's about taking responsibility, discovering about yourself, and then coming up with a plan. Because you are the one that's really kind of, in a way, each individual trader is the one who's we're holding ourselves back, really. I mean, that's what it comes down to. So it's not that the private funds have an advantage. It's not that the banks have an advantage. It's not, if you think about it, like the leverage that the average Forex trader has is much greater than any private fund has. I mean, I can guarantee you that the private funds don't have 500 to 1 leverage or 200 to 1 leverage or whatever, right? So there are they're not in and out. It's tricky for them to move out of their positions, get in and out. They're not as nimble as retail traders are. So the fact that you're trading from your underwear with high leverage in your living room or whatever, there are a lot of advantages that people don't think of. They don't really consider those. So yeah, to me, I think it is stacked against the average trader, but not for the normal reasons, I suppose, that people kind of blame it on.
Why do you think that the retail brokers get so much bad press then? I know that there certainly must be bad brokers out there. I wonder whether really the majority of it is that traders are sort of starting accounts being underfunded, and those small elements make a big difference then. Because I did recently try and just sort of checked out what new brokers were available in the UK, and I like to, for various reasons, I like to use Spreadbet Broker, and I like fixed spreads because it suits the way I trade, and I pay a little bit more on my spreads for that. But I've never been the sort of person where a slightly lower spread is going to make a big difference to whether I'm profitable or not. You could argue the fact over a long run that I would have made more money, but I think there's more to it than that for me personally. But why do you think there is such a mass of bad press about brokers? Is it because there are a lot of bad brokers, or is there something else going on?
I honestly think that there are brokers that are shady, and there are brokers that make it difficult for you to withdraw and slip you and give you bad ticks that pop you out of your positions and all those sorts of things. But the biggest problem, I believe, in my belief, is the trader himself. And I think that's the trader not wanting to take responsibility for the fact that they over leveraged and put too much risk on that account. And I think the stats bear that out. So we know that retail Forex brokers, the lifeblood, the reason why they exist is because they keep pulling in new accounts. If they don't do that, they die, right? And the reason why that's the case is because the accounts burn out. They have like a short shelf life. right? I mean, they just burn them out. These traders come in, they ramp up the trades, they take huge risks, and then they blow up the account. And so that's why Owanda, which offers a 50-to-1 leverage as a max leverage, that's why those accounts last longer than any other broker, because they offer the lowest leverage, right? So to me, it is correlational data. It's not, you don't know that it's causational, but I do believe that traders, in essence, can't get away from their own self, and they take too much risk, and then they don't want to take responsibility for the fact that they took too much risk on. So that's what I believe. I mean, I don't know. It just seems it's too much of a coincidence that the broker that offers the lowest leverage is the broker that has the longest lifespan customer. You know, the traders there last longer. It just makes sense. But I mean, I don't know. I mean, I just think it's easier for us to blame it on someone else than to say, you know what, you're right. I shouldn't have opened up a $3,000 account and taken 2 standard lots or whatever. You know what I mean? Like, I don't know. It's just crazy. Yeah.
What about the notion that algos and funds look for where all the orders are placed and take out all of our stops before reversing price in the original direction? So in kind of sort of sweeping for liquidity. Do you believe that? I believe that goes on because when you get to larger size, then obviously you need to find the liquidity to place your larger orders. And so this idea of hunting stops, is this something that's true to you or not?
Yeah, I think so. I think that's always been going on. I think you can go back and see that on the charts, in the 70s or whatever. I think you'll see that there, where essentially exactly what you're saying, like the reason why you get these little spikes and why price, as I see it, as a support and resistance trader, largely support and resistance trader, as I see it, these spikes that spike into support and resistance and then rebound off of that, those are signs of that, basically, that they're trying to probe the market into those areas where they know there are a lot of orders sitting there, so that they can basically pull them all off the board. Yeah, I believe that. Yeah.
And this is why when tested, a much wider stop initially performs much better. It's one of those things that is stacked against you as a retail trader, because your gut instinct is to pull your stop in tight and have as smaller risk as possible to try and get that big risk to reward. But the statistics prove that you want to use a wider stop initially. Then if price moves in your direction, then start to pull it up. And again, it's something that you very rarely see retail traders do. They tend to like to start with as tight a stop as they can under the support and resistance, and then move it to break even almost as maybe 1-to-1, say, too quickly, essentially. Whereas really what we should be doing is starting with a much wider stop and then bringing it closer to the trade, but not straight up to break even. So moving it to break even, not as abruptly. And then once it's moved so far a good distance, then move to break even. So again, it's kind of your gut instincts are kind of leading you astray. And if you study the charts long enough, then you realise that why that's not the best thing to do. But it's very hard to change that habit. I very rarely see traders talking about changing their stop placement. Their gut instinct again will make them look at the entry or the elements that are least likely to have a good effect on their profit.
Yeah, absolutely. Yeah, I think it's interesting, that you bring that up, because I recently read a study that they did. It was in stocks, so it wasn't in currencies, and there are slight differences the way that stock traders approach it, and currency traders, I guess, are closer probably to futures traders in the way they approach things. But what was interesting about the study was that he kind of looked at the baseline. He was looking at stops, right? And so the baseline was that he was going to have essentially a timed exit. So after a certain amount of time, they just pull the plug on these trades, and the trade was done. And the baseline was no stop. So there was unlimited risk, essentially. And that ended up being one of the best strategies. And when you looked at things like ATR based stops, so stops based on volatility. So you say that, like, for example, the euro moves an average of 85 pips a day, so you use a two ATR stop, so you have a 170 pip stop. Stops like that were awful. Were absolutely awful compared to the no stop scenario. So I just thought that was interesting, that some of these things, and I know you talk about this a lot, and I like to kind of think, what are other people doing, and how is it that I can do things a little bit differently? I know you do a lot of that in terms of questioning the norm, which I think is a really healthy thing to do, and just in life in general. But yeah, so I found that fascinating, that the volatility-based stop and the volatility-based exit strategies didn't work nearly as well as just a timed stop and a timed exit and no stop, right? So it was fascinating.
Yeah. To make the market not stacked against you, you do have to think outside the box, and it's probably a good exercise to just design a basic support and resistance trend pullback system, basic off the shelf one, and then just go through all the elements and just kind of question the sort of rationale behind them, because generally a lot of us are trading in the same way. We're all pretty much doing the same as everyone else, and if the majority aren't winning, then you need to question the thought process that makes you think that that's the right way to get an edge in the market.
Yeah, absolutely. I mean, that's the key. I think that we have to remember that where are we getting our profits from? Really, in the end, we're getting our profits from the other retail traders. Essentially, are donating their profit. They're donating their account, and we get to collect those profits if we make a profit on any given trade. So yeah. So what are you doing that's different to what they're doing? How are you able to be on the other side of their trade, in essence? So yeah, I think it makes a lot of sense. And that's why, like, to me, some of the most interesting traders, you'll hear them talk a lot about this, like, why has it always been done that way? These sorts of things come up. They kind of question the norm and wonder, why is it that people always do this, and why can't you do this instead? And these sorts of things. I think that's a healthy way, because it can lead you to a dead end, but it can also lead you to a fruitful place where you can collect different, it can be something that spurs a different direction. And to me, that's good. You don't want to be the guy that has a stop where everyone else has their stop, right? You don't want to be that easy, low-hanging fruit for the big boys to spike through and clear out your stop. That's not what you want. So yeah, I think it makes a lot of sense to do that. So yeah. All right, so I guess, Darren, we've basically decided that the markets are stacked against the average trader, but it's really the average trader's fault, right?
Yeah, and if you can find an edge, and you can learn how to not control your emotions, learn how to read, analyze your emotions, and you keep good records, then it's still possible to make consistent gains trading.
Absolutely. It's all about your own approach and how, being aware of how you're doing things. That's right. Well, thanks for your time, Darren. We'll see you next time.
Cheers, Walter.